Hey guys, this is Greg coming to you with another Fundrise video. This time we're going to be focusing on a letter that was just published this past weekend on Fundrise in my feed, and I think this went out to everybody, just to kind of go over what users should expect from Fundrise in a financial crisis. And again, I'm just going to read through this, and there's another letter that is linked in here that I'm going to go over as well, just to kind of give you guys, the viewers, an idea of where Fundrise comes from in respect to liquidity, where they're, how they hold the money for you, and things like that, so that it kind of gives you a better idea. It's not like playing the stock market. It's not like investing in there where, people do long term in the stock market, but there's a reason why they do it. They always say it's a long term investment, and I've said this on videos as well. Real estate is a long-term investment that you're going to use over 5, 10, 15, 20 years down the road, and you're going to be investing and you're going to make money. Historically, you're going to make around 10, 15% through real estate. Okay, so I'm just going to go over this with you guys, and we'll just talk about it at the end. So, a note from the CEO: what to expect from Fundrise in a financial crisis. During normal times, we typically send a letter to new investors outlining what they can expect from us during times of economic turbulence. However, during the current environment, we feel it's appropriate to outline how we've begun to make those necessary steps to protect the entire Fundrise investor community. So, in an effort to ensure that all Fundrise investors understand the illiquid nature of our product, we typically send each investor a letter titled "What You Should Expect from Us During the Next Financial Crisis," shortly after they make their first investment. The letter, first published in 2017, not only highlights the importance of understanding the illiquid nature of our product, but also outlines our strategy for protecting investors during times of economic turbulence. The quote from it directly: "During a financial crisis, there is a significant volatility in asset pricing due to the enormous sense of uncertainty about the future. In such circumstances, Fundrise will almost certainly suspend our redemption program, and investors should not expect us to provide them with liquidity." The ongoing COVID-19 pandemic is exactly the type of storm we refer to in the letter. A true black swan, impossible to predict, and yet has caused, and almost certainly will continue to cause, massive disruption. As a result, we've taken action to protect the entire Fundrise investor community according to the framework outlined in the aforementioned article, which I'll go over in a little bit. In March, we chose to suspend the redemption program for our mature e-REITs and e-funds in order to help safeguard our investors' portfolios from the potential negative consequences caused by the pandemic. You can read more about this decision in our letter to investors titled "We Built Your Fundrise Portfolio to be a Fortress in Times of Uncertainty." After a thorough analysis, we have resumed the process of redemption requests, though it's important to remember that we would likely pause redemption programs again in the event of a similar future crisis, and investors should not expect us to provide them with liquidity. In light of these recent events, we felt it was more important than ever to share this letter with you and to reiterate the necessity of having a long-term horizon when investing with us. While the current level of economic uncertainty can be challenging, we've spent the last several years building a portfolio focused specifically on benefiting from the inherent stability real estate can provide, and then systematically structuring our investments to protect against downside risk. Though a financial crisis isn't pleasant to think about, with the right preparation, it can reveal its own expected opportunities to come out ahead. We ask that you please take a moment to read both letters, and as always, provide us with any feedback. So we're going to go into what you should expect from Fundrise during the next financial crisis. And again, this was published in October of 2017 and updated in November of 2018. So they do want to note that anytime they mention investment performance in this article, it applies only to historical returns, only from the time frame defined, and only in regards to the Fundrise offering specified in this article. So, though it may seem like a strange notion, I spend time every day preparing for the next financial crisis. As CEO of a financial technology company is arguably the most important part of my job. At Fundrise, we tend to follow this advice of the great value investor Seth Klarman, who said, "Take care of the downside, and the upside will take care of itself." While it may be unclear what will trigger the next recession or when exactly it will occur, its eventual arrival is inevitable, foreshadowing, and denying that fact will only take it that much more difficult to handle once it does. Make no mistake, winter is coming. So, instead of wasting time debating, we choose to focus our energy on determining how best to prepare. The funny thing about black swans is that by definition, they can't be predicted. So rather than build an investment strategy around forecasting the market's up and downs, hoping that a life raft will just magically appear when things get choppy, we've instead set out to build an ark capable of weathering unexpected storms, assuming that eventuality will once hit. We do this by consistently seeking to make sound investments with strong fundamentals, even if it means being slightly more conservative in our approach than others around us. We focus on the intrinsic value of real estate, choosing to invest in areas with high barriers of entry and at prices that are at or below replacement cost. So they're talking about below the cost of constructing a new building of similar quality. We believe strongly that if we invest in markets with stable or rising demand and own properties at a lower cost basis than our competitors, then over time our investments should experience stronger than average returns and performance, even if the market goes down for a downturn. So, while financial crises are rare, such downturns often prove to be crucial turning points on the path to building wealth. All too often, investors, both big and small, get carried away by the intense emotional things sweeping through the economy and end up making rash decisions that they later tend to regret. It is therefore critical that our investors understand we built Fundrise to insulate our investments from these emotionally driven periods, in the hopes that we, with our investors, are not only able to weather a financial crisis, but what better yet, succeed during it. And that's why they have a quarterly period in which you can, get your funds back, but it has to go through an approval process. So again, it's one of those things where you can't just say, "Hey, I'm selling all this right now." It's going to be you have to go through an approval and get it sold. So it's really a built-in way of not selling through some kind of crisis, which I think is really great. The most experienced investors know that during a financial crisis, there is significant volatility in asset pricings due to the enormous sense of uncertainty about the future. The fear caused by this uncertainty can often be exacerbated when, in 2008, the very institutions that everyone assumed were most prepared for such an event turn out not to be. If you watch the movie The Big Short, you can kind of see what they're talking about here. If you guys aren't aware of what happened in 2008, watch that movie. Great movie. As fear takes hold, credit dries up, lenders withdraw from the market, and normal businesses grind to a halt. This usually leads to forced selling of assets, as margin loans are called, and companies and individuals alike seek to cover unexpected liquidity demands. This forced selling in turn leads to a temporary plunge in asset prices, as everyone waits to see where the bottom will be. So in such circumstances, Fundrise will almost certainly suspend our redemption program, and investors should not expect us to provide them with liquidity. And I will say that during the pandemic, Fundrise did this. So they were showing a way to weather the storm. So people weren't just panic selling their investments and just tanking the system for everybody else that was involved in the system. So while this is true for a number of reasons, the first and most important is that it will almost certainly be the best long-term interest of our investor base as a whole. During turbulent times, the value of our underlying real estate property will inherently be unclear. As a consequence, determining the net asset value, the NAV, of our investments will be extremely difficult, and allowing for redemptions at NAV in the midst of a sudden downturn would almost certainly result in mispricing and poor results for both those investors attempting to redeem as well as the ones that remain invested. We will likely want to allow a minimum of 6 to 12 months for the market to settle before determining the reasonable NAV and allowing for redemptions to begin again. So to be clear, we've built Fundrise for those investors who want to outperform the stock market over the long term. We invest in real property because of the many benefits that come with owning it, higher yields, higher potential returns, and generally great stability. But those benefits come with a trade-off, primarily liquidity. By its nature, real estate is an illiquid long-term investment with a natural duration measured in years or even decades. Properties increase in value as macro growth trends out around them. Investors who are patient enough can experience exceptional performance as a result of that growth. However, selling a property before it's had sufficient time to mature is likely to result in poor returns. Even more importantly, doing so during a financial crisis is likely to result in painful underperformance. So while under normal market conditions we seek to provide our investors with liquidity through the redemption program, during a financial crisis, investors should expect it to be paused for enough time for whatever events may unfold. So we believe that the majority of our investors have specifically chosen Fundrise because of the benefits that come from owning a portfolio of illiquid real estate over the long term, and consequently expect us to have make sound decisions with this in mind. During a downturn, that almost certainly means not taking losses as a result of forced sales and likely not sparing precious capital to satisfy a minority of individuals seeking to redeem their shares. To the contrary, we anticipate preserving capital in the interest of adding value to our real estate investments if and when the opportunity presents itself. So in other words, the cash reserves that they hold are meant for the benefit of the whole investor base, and is more likely that they'll use them to buy high quality assets at depressed prices than giving liquidity to a limited number of investors. So they would rather invest that money that they have on hand than just hand it back out to the investors that are trying to just get out because they see the market tanking. So to summarize, if you think you may need liquidity from your investments with us during the next financial crisis, i.e. what happened this past year and a half, then Fundrise's long-term illiquid state is probably not the best bet for you. Okay? So because none of us want to see another financial crisis, that doesn't mean that we should blind ourselves to the inevitable. If we prepare for it accordingly, it may turn out that the stability of our portfolio combined with our broad base of long-term investors actually creates new opportunities not available to most others in the market. Until then, onward, Ben Miller, CEO and co-founder of Fundrise. So what do you guys think about that? The illiquid base of this does really throw some people off, especially newer investors who, are in the Robin Hoods, the Weebles, and just kind of putting their money in, throwing it to something, and just sticking with it. There's a lot of people, newer investors, that are more into just making a quick buck, drawing it out, finding something new instead of just putting into something and making an investment for the long run. What do you guys think of that? Would you rather be illiquid in Fundrise and be able to see that value grow over 20-25 years, or would you rather put it in something like a regular brokerage account where you can just kind of pin it back and forth? Personally, I use a Roth. I have a brokerage. I have some money in crypto, and I also have some money, as you can see, in Fundrise, and I plan on divvying it out and putting in that kind of money every pay period into something like Fundrise that will have that longevity and grow over time, especially in a portfolio that is just ramping up and will start showing returns in 5-10 years. So let me know down below your thoughts on that. If you like this video, if you liked me going through and reading this and kind of going over my own thoughts, please make sure to hit the like button. Make sure to subscribe to the channel and hit that little bell. And make sure to check out my other videos if you haven't checked anything out yet. Any comments, concerns, questions, make sure to put them in the comments, and we'll see you guys next time. Take care. Bye.